Welcome to TMS Insights. It's been a busy time, Ben. We had the budget last night. We'll touch on that. It's been a busy time in equities overall. And one of the more interesting periods I can remember. There's a lot to break down. We want some US quarterly results, which have been really, really good. So there's a good story there. Some of the Aussie stocks mixed, and we'll highlight and talk about some particular ones there. But why don't we start with the good story, because and we'll get to the budget briefly at the end with a follow-up video to come later in the week. But Ben, the budget overall did not talk about super. That was something that was important. We've had previous changes. It talked about CGT. It talked about negative gearing, but it didn't touch that one. Overall, the market will be concerned about it, interested in it, but there wasn't any real stingers there for what is the main savings vehicle for Australians.
Yeah, it's that area's been carved out. A lot of change in other areas though, and I think it's going to, for a lot of our clients, potentially it's going to need a fresh set of eyes looking at how structures are set up and whether they're still going to be the right way to do it going forward. But we'll have Matt Salmon on talking with you.
And James, and we'll have a good...
we want to digest it for a day or two. We don't need to rush on any of this stuff, but to come back to clients and give a sort of our view on the changes that have been announced. I guess from a market point of view, Jez, it's not a friendly budget for the economy. I think there's a lot of money going from here to here. There's no plan to grow the economy or to help businesses grow. And, I think normally we don't talk about politics because...
We don't talk about the budget a lot.
No.
These videos, we don't see the need. This is the most consequential budget in more than a decade.
It is.
There are personal finance and market and economy-wide related consequences. But in terms of growing the national economy, there wasn't anything that excited me. And I think, what we're more excited about, Ben, is... what we will pivot to now is the opportunity set of investing overseas. And, I think this is going to be the natural consequence of such a heavy fiscal imposed. The savings that have been made have been spent in this budget. So there's no great fiscal tightening.
And not spent on the intergenerational transfer. I mean, it's just hard to understand.
And the RBA will not see what they wanted to in this. So the bond sell-off that we've seen overnight is a natural consequence of that. But there are some really phenomenal offshore stories, to talk about. And we're now talking about a currency at 72.5 US cents with a dollar. So it's about as favourable as it's been for a long time to buy US dollar denominated assets. But that is where there is earnings growth, Ben.
Absolutely. I mean, the US quarterly season has been one of the best we've seen in recent history. So think whatever you want about Trump, and we've listened to a lot of US fund managers when they've been down here, particularly this year. And I went to a presentation with a bond manager who was down here talking about the amount of red tape that the Republicans have removed, the business-friendly, almost over-friendly environment in terms of letting down guardrails, knocking over fences and saying to businesses, go and have a crack out there. You haven't been allowed there before, but you can now. And it's washing through into the earnings of the businesses listed over there. And if you just look, I mean, we still have this is the last week of the quarterly earnings season, but they'll do about 17% earnings growth on the quarter.
And it's forecast for next year at 17% as well.
It is. So now that's unbelievable. It's nearly double the 30-year average earnings growth of America. So
and let's just give everybody a flavour about earnings here relatively outside of resources. It's going to be low single digits. It'll be 1% to 2%. So it's going to be incredible. And we just heard from Commonwealth Bank today, which was a negative.
Minus 1% profit growth for the quarter. So not a great set of numbers from the biggest bank. I mean, if you look at JP Morgan and the US Main Street banks, not the investment banks, they're doing about 12 to 13% earnings growth. And they're trading on PEs, which are around half of Commonwealth Bank's. So, it's frustrating as an Australian, I find it, because, I feel like a handbrake is being applied to a lot of businesses in terms of trying to grow. But if you're a global pension fund and you're looking at Australia or South Korea or America or other countries, that's where the capital's
Well, you're
going to flow.
agnostic about geography,
Yeah,
so you
you
go
don't
to where
care.
the earnings growth is and the opportunity set. And as you said, well, we knew this when Trump got in the second time. Red tape would be ripped out.
Yeah.
And that was coming early, wasn't it? And we're now seeing the consequence of that with the freedom of
The
business.
the big beautiful bill, as he's termed it, which I got to say I didn't fully understand some of the stuff.
We don't hear, do we?
No.
That's why we have to go there or hear from the people who are there.
that
on
are
the
there.
ground.
And there's some things that I've been told which are gobsmacking in terms of how, like, tax treatment of amortization of new build assets, as long as you're using US steel and US components within there, if you're
Massive
building it,
concessions,
it's huge.
So it's freed up business in a way.
Yeah.
And to talk about some stocks, I mean, standouts, Alphabet, obviously one of the best in this reporting season, but it's had a wonderful year, hasn't it?
Incredible. Alphabet, which is Google, it has reinvented itself. A year ago, it was seen as being AI roadkill, the search business. It's now seen as being the poster child of AI with the Gemini business. It's also now developing chips which could rival NVIDIA's at some stage, and just completely locked in. They've done an extraordinary job. But we also saw from whether NVIDIA or Amazon, Microsoft had a great result. It's been the semiconductor stocks there have been. I think the semiconductor index is up like 60% this year, something like that. So our technology shares significantly underperformed because they're all software businesses. US software businesses also underperformed. So although you can look at some of the software stocks here and think, oh, they're struggling because these businesses are doing so well, which is seen as the potential competitors to these guys.
And we've always said this about the Mag 7, the optionality there.
Yeah.
Things you don't actually know that are going on within. They're reinventing themselves consistently. And that can be even cannibalizing good businesses within Google search to create the new decade's opportunity set. So, and this is the power of destructive innovation. And you create the new by destroying the old, and they do it better than anybody.
And just the other thing I call out, because in past quarterly earnings seasons we look at in America, it has been very concentrated, but this has been different, where a lot of US Main Street businesses have reported very strong results. So if you look at Walmart, McDonald's, Starbucks, companies like that have had, and US banks. So it's been much more broad-based, the earnings growth. It's not a small number pulling everyone else up, which shows signs of business-friendly economy and consumers that are spending and an interest rate situation, which broadly there'll be.
Well, they've had rate cuts this last year, and we've been going the other way.
So that's another
cost of doing business has gone down there in many formats. But takes us back home where things aren't as rosy. We'll talk some individual stocks, but I suppose we come into this season in May. It's often known as the confession season, where you get earnings downgrades. We've had a few, but there was expectation to be a lot in that last week's Macquarie conference, and there weren't that many, Ben.
No, I think it's like 63% of the ASX 200 presented in 3 or 4 days a week ago. There was a lot of nerves going into it because that's when a lot of companies provide trading updates, and there was just this feeling that the economy had really started to lurch over, which I think is true, but business seems to be holding up better than expected. So there were some downgrades, but it was fairly minor in terms of the number. I mean, we've had one or two that we've had, but generally, it's the weakness that we've seen in the Australian market has not been driven by worse than expected earnings. It's more higher interest rates, poor sentiment, I think, from offshore. We've seen the resource part of the market's torn ahead, which I think is pulling capital out of other stocks. And just the concern of, looking forward, if you look at like retailers as an example, they're off like 50 to 70% this year. It's been a bloodbath. So the more like discretionary sort of things have been hit really hard.
Well, and that sort of takes us to an area which resources have been fantastic. There's no doubt there's been a big winner, and those leading stocks in that space are flying. Healthcare's been a poor one. And to talk about a couple of names, we've got Cochlear and CSL, which are well down. CSL had its first big, it's had a couple of downgrades now, 3 in total. Cochlear was a really bizarre one, Ben.
Yeah,
That was really
out of
almost
nowhere.
left field.
Yeah.
One of the more unusual things for a big cap stock that I've seen. And you talk about discretionary spend. There was suddenly the nature that maybe the hearing aid market may be more discretionary than thought.
And that's what the CEO sort of said. Cochlear's got this incredible new product that's coming out, and there's a lot of excitement about the ability to effectively upgrade it over a network rather than having to surgically upgrade it. It's a competitive edge that none of the competitors have got, so it places them in great stead. But Dick Howard, the CEO, sort of said that the reality we're facing is people being diagnosed with hearing loss and they're not doing anything about it. And so his view is the only way to fix the issue they've got is education. It's making people aware of, you don't just lose your hearing, you're much higher chance of dementia and longevity significantly reduces and all these sort of things. And if you don't treat it, that's what's going to happen. And clearly that's an issue for them because that weakness did come out of America. It was much more predominantly in the US.
And the US has been the source of some of CSL's issues too, that one. Again, we mentioned that February, Paul McKenzie was sacked. The result next day, and then another downgrade only earlier in the week.
That's it's just hard to fathom 3 months after reaffirming earnings guidance that you've had another downgrade. It wasn't the biggest downgrade in the world. The earnings of the business, they're downgraded by 3 or 4%.
The revenue line, it was almost insignificant. But
it's just another chink. It's another cut from a business which used to be seen as the best communicator with the market. It warranted an incredible earnings multiple. We're now looking at an earnings multiple of about 10.
10 times.
It's hard to believe, but until they start to get back on track with, under-promising and over-delivering.
The market's expecting another downgrade based on that pricing. There's no doubt about it. ResMed's numbers were good. And it's sold down. Is that just part of the whole sell-off in that sector?
It feels like Fisher & Paykel's another one. ResMed and Fisher & Paykel Healthcare are both in upgrade cycles. So, one thing I've been saying to clients is, at the moment, you can buy high-quality growth businesses that don't have earnings issues on much lower Ps than we've been used to paying. You don't have to feel the need to take on a company that's in a downgrade cycle hoping that that's about to start turning and you're picking up a bargain. So ResMed at $28 is trading on the lowest PE it's been on in probably 10 years. And the business is consistently delivering low double-digit earnings growth. It's doing on-market buybacks. It's got no debt. It's just everything you want to see. It's got a driven management team. Fisher & Paykel's the same. They're the stocks that you want to look at.
There's some cheapness in sectors there, like you said. Talking banks we mentioned before, and we'll wind up in a sec, but Combank's result was out. It's been expensive. Macquarie Group, again, quarterly earnings, good numbers, Ben.
Ripper. That result, it took me a while to understand the commodities business in that Macquarie's great at hedging risk. It's like one of the things they advise people on. And this commodity trading business, when you look at it, when things go to crap globally, what you almost inevitably get is volatility in commodity prices. So you look at Iran, you've had the oil price all over the place, the gold price all over the place, and then this commodity trading business, which is world leading, makes so much money it's not funny. And it hedges out the other businesses which might come under a bit of pressure because capital markets close or floats dry up or, deals are slow down. So it's, this part. So that it was an awesome 6-month period for them. They're back. It feels like they've been in a bit of a downgrade cycle themselves. So you don't want to give up on good companies when they're in downgrade cycles because they won't last forever, hopefully. And I think this business now, it's looking like a buy again for me because it's traded at this price in the past, but the earnings now are much higher than they were back then. So you're not paying, and the return on equity is back to 14%.
Strong again. So it's in town.
We haven't seen that above 10% for years. So it's
good to see.
good.
No, it's a good one. All right, we'll wind up now. We will come back to you about the budget, and just bear in mind it's only been the announcement. It's not legislated yet, so there is no actual action required straight after the budget announcement. But there are a few things for us to start planning and getting our heads around, and we'll be here to provide those answers to you. But as I said, we'll also provide a video in the next few days with some more content and for the key takeaways that you'll need to be looking at. So we'll bring that to you very soon as well. And another update, as we do, from the TMS Insights team in June.